You've been told your whole life to save your money. Put it in the bank. Build an emergency fund. Don't spend what you don't have. That's not a wrong advice. But here's what nobody tells you. Saving alone will not make you rich. In fact, in today's economy, saving alone might actually be making you poorer. So which one wins, saving or investing? The real answer might surprise you, because it's not actually one versus the other. It's about knowing when to do which one, and in what order. Stick around. By the end of this video, you'll have a crystal clear picture of exactly where your money should be going, and why. Welcome back. Today we're settling one of the most common money debates out there, saving versus investing. Here's what we're covering. 1. What saving actually does to your money over time. 2. What investing really means, and why most people are afraid of it. 3. The hidden enemy called inflation that nobody talks about enough. 4. The right order to do both. And 5. A simple action plan based on where you are right now financially. Let's get into it. What saving actually does to your money. Let's start with saving, because saving is good. Let's be clear about that. A savings account keeps your money safe, liquid, and accessible. When your car breaks down or you lose your job, savings is what keeps you from going into debt or financial panic. But here's the problem. The average traditional savings account pays somewhere between 0.01% and 0.5% interest per year. Some high-yield savings accounts today offer around 4 to 5%, which is actually decent. But historically, savings accounts have paid very little. And here's the real kicker, inflation. Every year, the cost of living rises. Historically, inflation averages around 3% per year. So if your savings account is earning 1%, you're actually losing 2% of your purchasing power every single year. Your balance goes up. But what that money can actually buy goes down. That $10,000 sitting in a low-interest savings account for 10 years, it might say $10,500 on paper. But in real terms, in actual buying power, it's worth less than when you started. Saving preserves your money. It doesn't grow it. What investing actually means. Now let's talk about investing, and let's clear up the biggest myth first. Investing is not gambling. A lot of people hear stock market and picture someone glued to a screen, sweating over every price move, winning big or losing everything. That's trading. That's speculation. That's not what we're talking about. Investing, done correctly, is simply putting your money into assets that grow in value over time. The most accessible form for most people is index funds. An index fund is basically a basket of hundreds or thousands of companies bundled together. When you invest in one, you own a tiny piece of all of them. The S&P 500, which tracks the 500 largest companies in America, has returned an average of about 10% per year over the last century. Not every year. Some years it drops. Some years it surges. But averaged out over decades, 10%. Compare that to a 1% savings account, or even a 5% high-yield account. The difference over 30 years is staggering. And we'll look at the real numbers in just a moment. Investing does come with risk. Your balance can drop in the short term. But for money you don't need for 5, 10, or 20 years, the historical evidence is overwhelming. Investing wins. Let's talk more about inflation because this is the silent wealth killer that most people completely underestimate. Inflation means that over time, a dollar buys less and less. In 1990, a movie ticket cost about $4. Today it's closer to $15. Same experience. 3 times the price. That same pattern applies to groceries, rent, healthcare, education, everything. So when you leave money sitting in cash or a low-interest account, you're not being safe. You're slowly losing ground. Here's the equation that matters. Your real return equals interest rate minus inflation rate. If inflation is 3% and your savings earns 1%, your real return is negative 2%. If inflation is 3% and your investments grow at 10%, your real return is positive 7%. Over decades, that 7% real return is the engine that builds generational wealth. This is why keeping all your money in savings isn't playing it safe, it's just losing slowly instead of losing fast. So here's the key insight of this whole video. It's not saving or investing. It's saving then investing. In the right order. I repeat, saving then investing in the right order. Think of it like building a house. You need a foundation before you build walls. Saving is the foundation. Investing is the structure that grows on top of it. Here's the order that actually works. Step 1. Build a starter emergency fund. Before anything else, save $1,000 as fast as you possibly can. This is your buffer against small emergencies: a car repair, a medical bill, a broken appliance. Without this, one unexpected expense sends you straight to a credit card and into debt. Step 2. Pay off high-interest debt. If you have credit card debt at 20% interest, no investment in the world will reliably beat that. Paying off that debt is the guaranteed 20% return. Crush it first. Step 3. Build a full emergency fund. Once the bad debt is gone, build your emergency fund up to 3 to 6 months of living expenses. Keep this in a high-yield savings account. This is your security net. It never gets invested. It stays liquid and safe. Step 4. Now invest. With your foundation solid, every additional dollar should be going to work for you. Start with any employer-matched retirement account. That match is free money. Always take it. Then max out tax-advantaged accounts like a Roth IRA if you're eligible. Then a regular brokerage account. Step 5. Keep saving for specific goals. Down payment on a house in 2 years? That money stays in savings because you can't afford to have it drop right before you need it. Short-term goals stay in savings. Long-term wealth building goes into investments. The order matters. The foundation matters. But once it's in place, investing is where the real wealth happens. Let's make this real with some actual numbers, because this is where it clicks for most people. Scenario 1. The saver. Someone puts $400 a month into a savings account earning 2% per year for 30 years. Final balance: roughly $196,000. Scenario 2. The investor. Same person. Same $400 a month. But it goes into an index fund averaging 10% per year for 30 years. Final balance: roughly $905,000. Same money. Same time. Nearly $700,000 difference. And remember, inflation is quietly eating into that savings account balance the whole time. In real purchasing power, that $196,000 in 30 years buys significantly less than it sounds like today. The investor didn't work harder, didn't earn more, didn't take crazy risks. They just put their money in the right place and let time do the work. That's the whole game. That's the secret the wealthy understand that most people don't. So let's bring it all together. Saving is essential, but it's a tool for protection, not for building wealth. Investing is how your money grows faster than inflation, faster than time, faster than anything else available to the average person. The answer isn't saving or investing. It's building your foundation with savings, then putting every extra dollar you can into investments and leaving them alone for as long as possible. Start where you are, with what you have, even if it's $50 a month. Because the biggest mistake isn't investing wrong. It's not starting at all. If this video gave you clarity, drop a like. It helps this channel more than you know. And subscribe if you want straightforward money content every week. No fluff, no hype. Comment below. Are you currently a saver, an investor, or trying to figure out the balance? Let's talk about it. See you in the next one.